The key thing that's driving gold too is we still are having this, T-bills, 10-year note, 2-year note just probably maybe peaked around 5%.
Right.
When that goes lower, I didn't say if. I think that might have been the peak for the year. And when or if the U.S. stock market starts having a bit of normal bull market back and full, I didn't say bear market yet. That should take gold off. What's significant about it is the World Gold Council just put out their latest quarter Q1 report. Those guys are good. I've been following them for a decade. And Q1, there was 290 metric tons of net buying from central banks in their database since 2000. That's the most ever for Q1. So it's the premise I've been pointing out for years. When the deepest pockets on the planet, central banks, are accumulating gold, probably better go with that trade. It's just a matter of time. I think it gets to $3,000 an ounce.
Despite ending the week with a modest 1% loss after a substantial rally of over $400, the gold market has exhibited resilience, maintaining support above $2,300 per ounce. As market sentiment stabilizes, attention shifts towards the Federal Reserve's monetary policy decisions and interest rate outlook. MikeMcGlone, senior commodity strategist at Bloomberg Intelligence, foresees gold eventually reaching $33,000 per ounce. He identifies key support levels ranging from $2,000 to $2,200, suggesting that investors perceive any price dips as buying opportunities. Despite the potential for further declines in gold prices amidst the Fed's stance on monetary policy, a complete market collapse is not anticipated. While the Fed's posture may not be excessively accommodative, it also isn't aggressively hawkish. Moreover, the fundamental factors that previously drove gold to record highs persist, with central banks displaying a strong appetite for gold, bolstering its performance relative to the S&P 500. This outperformance is seen as a concerning signal for the global macroeconomy, hinting at recessionary pressures despite advancements in AI-driven stock trading. Interestingly, gold's remarkable performance has overshadowed the S&P 500 in 2024, underscoring its enduring appeal as a safe haven asset. However, silver, while demonstrating recent strength, is approached with caution by McGlone due to its close correlation with gold and potential alignment with commodities like copper. Silver faces downward pressure amid recovering U.S. dollar and bond yields, compounded by uncertainty surrounding upcoming economic data releases such as the United States non-farm payrolls and ISM Services PMI for April, scheduled for publication on Friday. Stay updated with insights from MikeMcGlone by subscribing to our channel and activating notifications. Thank you for joining us.
It's all about rotation and cyclicality. And I think as far as needing it, well, it's proven it hasn't needed it because we've had, here's the numbers. We had significant outflows in gold ETFs. If you take from the peak, when gold ETFs peaked around 110 million ounces,
Right.
there's been liquidation of about 30 million ounces. And that's like, what, 25, 30%?
Yeah.
At the same time, over that same period, there's been purchases by central banks of almost 100 million ounces based on the latest data. So it's offsetting. At some point, those ETF outflows are going to switch to inflows.
Right.
Just a question of time and what it's going to take for that to happen. But I like to point out, just as we're speaking right now, gold on this year alone is total return is around 12%. The S&P 500 is around 6%. So it's doubling that AI-driven S&P 500. That's not a good sign. I mean, that's bad. And gold is since the end of 2021, which was a significant period because the Fed started tightening in 2022. Gold is outperforming the S&P 500 total return. And all you hear about AI and the rock-beating stocks is not a good sign for the global macro economy, and that's kind of my tilt. I think that's what's happening now. So that tilt we had towards severe recession last year didn't work, and the tilt we had toward this year towards no recession and no landing this year is tilting back. And key thing I want to point out is you have bond yields in China dropping to the lowest versus the U.S. in our database, like 2.3% now.
Right.
Those long bond government bonds are indicating severe deflationary forces from a country we just can't believe their data anymore because it's really being led by one person who has a vested interest in making you believe a narrative. Higher. Question is how much. Probably accelerate if we start seeing a bit of a bear market kicking in the stock market, which we might get an indication from. We're going to publish this after the payroll number on Friday.
Mhm.
That might be a bit of a inflection point. To me, the macro for gold is, I don't want to annoy our listeners and readers and viewers too much. It's just a matter of time. I think it gets to $3,000 an ounce.
Wow.
And now the key support is 2,000, which might have kind of bumped up to 2,200 for responsive buying and dips, but it's just a matter of time. And the key thing that's driving gold too is we still are having this, T-bills, 2-year note just probably maybe peaked around 5%.
Right.
When that goes lower, I didn't say if. I think that might have been the peak for the year. And when or if the U.S. stock market starts having a bit of normal bull market back and full, I didn't say bear market yet. That should take gold off. What's significant about it is the World Gold Council just put out their latest quarter Q1 report. Those guys are good. I've been following them for a decade.
Right.
And Q1, there was 290 metric tons of net buying from central banks in their database since 2000. That's the most ever for Q1. So it's the premise I've been pointing out for years. When the deepest pockets on the planet, central banks, accumulating gold, probably better go with that trade. Now, silver, I'm a bit stuck on. Silver, I'm still worried it's going to trade more like copper. You've been right. It's been doing well this year. But I think the problem with silver is it's more a beta to gold.
Right.
And gold is the only major commodity on the planet making all-time record highs. I think that's going to continue. Silver's just bumping up against resistance. So far, it's holding 30. Now it's backing down to 26. It's probably going to hold. But if copper does what I think it's going to do and the stock market goes down, gold's going to be the shining star.
During its latest meeting, the U.S. Federal Reserve chose to keep interest rates steady, signaling a sustained inclination towards eventually lowering borrowing costs. However, concerns have emerged regarding disappointing inflation figures, which might postpone any imminent rate cuts. Federal Reserve Chair Jerome Powell emphasized that despite the rapid price upticks observed in the early months of 2024, policymakers anticipate a prolonged period before they regain confidence in steering inflation towards the targeted 2%. MikeMcGlone suggests that the Fed will persist in its efforts to ease monetary policy until indications from the stock market necessitate intervention. McGlone interprets the recent surge in stock prices, coupled with persistent inflation and reduced expectations for rate hikes, as indicative of the Fed's accommodating stance. Following a softer-than-expected April jobs report, stocks experienced a notable rally on Friday, fueled by hopes that the Federal Reserve might soon implement interest rate cuts. McGlone anticipates a potential stock market correction, which could herald the beginning of an extended bear market cycle. They point to commodities like gold as indicating signs of this shift. Let's return to the interview.
Put it this way, I don't think the Fed's going to ease until the stock market goes down and tells them to. I don't think it's coincidence that we've had a bounce, a pretty significant rally in the stock market from those October lows, which I feel is very suspicious, and sticky inflation and Fed rate hikes expectations tilting away, being pushed away. It's the high price cure. It's just stock market going up is it's the most significant period in history, I think, where the stock market is directly related to wealth and inflation, as is housing, as I look around the condos in Miami. And until those assets go down a little bit, we're going to have sticky inflation. So they have to go down, I think, but certainly the stock market leading for us to get the eases from the Fed. And this is the issue I think market missed is the Fed's not going to ease until risk assets go down and tell them to ease. And I think that the U.S. stock market's leading indicator. That's why I'm pointing out a lot that S&P 500, 5,000 inflection point. I see gaps below at S&P 5 E-minis, S&P 500 E-minis, and just a normal correction. I will publish on Friday, by the time this comes out, that we just drop, 10% down to 4,500. Still just inching up towards significant upward sloping trend lines. It just got too high. So to me, that's the thing about the Fed. The Fed, to me, is insignificant right now, and their next move will be ease, and I don't think it'll be until the stock market goes down and tells them to. And that, to me, might be the beginning of an elongated cat and mouse game that I think we're way overdue for a bear market in the stock market. It's just a normal cycle. I mean, it's the normal cycle is kicking in commodities is a bear market. That's where I think gold's sniffing it out. But what's going to change that? I think what I'm enjoying hearing is everybody keeps saying the data is strong, but you look at stocks like Starbucks dropping.
Oh yeah, collapsed.
Yeah, I mean that's. I look at my lead indicators. Diesel demand in this country has dropped to the same level as 10 years ago. It's like never happened outside of a recession. Oh yeah, diesel demand, paperboard, corrugated boxes demand is dropping. Unleaded gas demand is falling. I mean, we still have an inverted yield curve, and leading indicators are still negative. All that stuff that used to matter and then stopped mattering because the pendulum swung. I think it's going to start mattering again. And the number one thing catalyst is S&P 500 sustaining below 5,000. That's the first little inflection point. And that's what I do as a ex-trader, now strategist. You're always looking for the big picture macro and the inflection points. And here's a key reason why I think it's going to do that this time.
Yeah, why?
Well, we'll figure we get there anyhow. So I save you the question. It's the number one major rules of markets is mean reversion can be the most powerful force in markets. And in volatility, mean reversion always happens. It's just a question of time. So I look at the VIX volatility index. If you take the 20-week moving average or the 50-week moving average, I subtract out the T-bill rate because that's a major pressure on the stock market, is high T-bills and low volatility. And that level now is dropped below 9%. It's about the lowest level since 2007, which was one of my major signals that preceded the great financial crisis. Now, I didn't say I predicted it, but back then at that time, I was at a hedge fund and traded very well for it, being partly just expecting volatility mean revert. So that was one of my key signals. And also the signal you get globally from CGBs, those are Chinese government bond yields dropping to the lowest versus JGB since about 2000 and, well, in our database since about 2006.
What do you think about the Federal Reserve's choice to keep interest rates where they are? How could worries about lackluster inflation figures affect when rate cuts might happen? Feel free to share your opinions in the comments. If you found the video interesting, consider joining our community by subscribing to our channel and hitting the bell icon to receive notifications. Thanks for being a part of our community.